Good morning, and thanks so much for tuning in. This is Stocks to Watch on BloombergQuint, and I'm Alex Matthew. The cues from the US markets, at least, are strong, but our benchmarks, remember, have gained for 8 straight sessions. So we're going to have to see whether that trend continues. We're going to talk about some of the stocks that are likely to be in focus today. And joining me is Gurmeet Chadda, co-founder and CEO of Complete Circle Consultants. Thanks so much, Gurmeet, for joining me this morning. It'll be interesting to see if that stellar gain that we've seen over the last week continues today. And hopefully, we're not going to be interrupted by any power cuts today. I know that we complain about it a lot here in Mumbai. But having said that, I do want to start with Wipro because I think that's going to be a stock in focus today. It's already a stock that has run up after TCS announced a buyback in the hope that Wipro would announce a buyback. And indeed, it did. Or rather, it's going to be in consideration today. And the earnings today. So what particularly are you going to be focusing on in the numbers and in the management commentary?
Good morning, Alex. Thanks for having me. I think you're right. I think we probably are in a structural uptrend for IT services. Wipro is fourth largest by market cap in the IT services space. A little more diversified. So if you see, it's other than the IT and the BPO services, it has the consumer-facing business, the domestic hardware business. So I think the commentary on the deal momentum would be very important. I think the expectation is that in dollar terms, the revenue would go between 3.5% to maybe 4%, and maybe in constant currency terms about 2.25%. Also, I think if you see the areas where they are seeing a lot of traction on deals is cloud adoption, collaboration, and security services. So it would be interesting to see the commentary there. Also, I would like to see the margin trajectory which management really comes up with. So overall, I think still at about $370-380. It's not as expensive vis-a-vis the top two, and I think the management is very clear in terms of returning to profitable growth, which is now evident. Also, I would like to see their performance and commentary on verticals like healthcare, the retail technologies, also on the utility front. That's also a decent part of their overall revenue pie.
But in the IT pack, would you say that Wipro is a good buy, or would you prefer someone else?
So I think I probably would want to, so before you would like to re-rate, I would watch out this quarter and the commentary before giving it a structural buy. But clearly from a momentum perspective, it is looking good. I like HCL Tech more, Alex, vis-a-vis Wipro. Reason being, as I said, three parts to HCL Tech. If you see, one is their IT services, second is ERP, and third is the platform, the software business which they've acquired from IBM. So that's looking very, very good. Also, I think on core modernization, the deal win momentum for HCL, considering the mid-quarter guidance, sounded very bullish to me. So HCL over Wipro to me for the long run, and wait out for Wipro in terms of the guidance they give going forward.
Fair enough. Now, the second counter today is SRF, and the counter is in focus because of a QIP which was launched yesterday at a price of 4,168.73 rupees per share. It's interesting because it's a 4.6% discount to the share price yesterday, but of course the share price ran up in anticipation of fundraising. I understand that they're planning to raise about 750 crore rupees. We don't have confirmation of that yet. But they're going to plan to use this on CapEx. And it's interesting, right? Because this entire pack, SRF, is part of the specialty chemicals pack that has been in so much focus, but perhaps a little more diversified than some of the other players. What is your view on the stock? Is it still a good buy at this price?
A touch expensive, but fundamentally a good counter to look at. And you're right. I think just when we look at specialty chemicals, we have to go to level 2 and understand what the product lines are. So SRF essentially is into three product lines. One is chemicals, of which specialty chemicals is a major part. Then you have HFC, and then you have refrigerant gases. Then you have technical textiles, which is what they supply to the major tire makers in auto. And third is the packaging. So the dominant two revenues is chemicals and packaging line. If you see the Q1 numbers, the margins were held by the packaging line largely because of the demand supply mismatch and SRF having the capacity to service. So if you see the capex intensity, Alex, for last 10 years, they've done, almost 8,400 crores of capex, of which about 60% has come in last 5 years. And again, two-thirds of that has gone into chemicals. So, so the capex intensity is high. So if you assume a fixed asset turn to zero point 0.6 to 0.65, you're talking of some, 400, 500 crores of additional top line in the chemical space, also helped by their Dahej facility as well as their HFC capacity, which has gone up from 17,500 to almost 35,000 MT. So I think packaging would see, after a 1 quarter jump, you may not be able to see those kinds of margins and trajectory. The technical textiles is coming back, helped by recovery in auto, and also the HFC will make a comeback with recovery in some white goods. So I think it's a diversified play, good company to look at. Any price correction is obviously welcome. If the QIP goes through, the EBITDA by the debt by EBITDA comes down from 2.5 to probably 1.1, 1.7 maybe, which is also on the margin positive for the stock.
Okay, so speaking of corrections, Gurmeet, we've seen HDFC Life, and I think that around this time last year, this was a stock and sector that was in a lot of focus, and it was running up and gaining from strength to strength. This 2020, thankfully, has rushed by. So we're already in October. But having said that, we've got this stock that is trading below its 5, 20, 50, 100-day moving averages, and it's within touching distance of its 200-day simple moving average. So one would say perhaps that it's at an interesting price to buy into. Would you agree, or would you say that this is just the correction that was anticipated after that stellar listing and the gains that it saw after that?
I think there is a bit of a consolidation. Anyways, the financials have been a bit of a laggard, Alex. I mean, obviously, life insurance has done better than banks and NBFCs. But if any insurance business, you value on two bases. One is your embedded value, which is the value of the insurer basis, its historical book, and one is on a VNB basis, which is value to new business, which is the value of the insurer on the business it's writing, right? So which we call as which we measure in terms of the VNB premiums and VNB margins. I think HDFC Life to me is a very good structural long-term play, and any correction and consolidation is an opportunity to accumulate. If you see the September AP numbers, they grew 43%. For the quarter, they've grown about 22%. So, and if you see the on the AP basis, if you exclude group insurance, they've actually beaten SBI Life. In fact, the premium collected is a little more than 4,200 crores, a shade higher than SBI. Also in insurance, when you look at, you have to look at this is a business where you pay premiums and for 10, 20, 30 years. So your quality of the business is extremely important, because it's from the future profits you make money. Persistency ratio in HDFC Life is top notch. If you see that they're consistently operating, ROEVs is about 18, 19%. VNB margins are about 25, 26%. And I think the best part about is the product mix and the digital abilities they've acquired. So they have the highest share of protection and annuity vis-a-vis, let's say ICICI Pru, which is more ULIP, and SBI Life, where again it is more ULIP but largely on the debt side. So I think their digital capabilities are top notch. The share of telemedicals now post-COVID is 55%. Used to be just 10%, which is probably not reflecting in the premium growth.
Fair enough. So I would say the consensus would therefore be that it's a strong, or your view definitely is that it's a strong buy even at this point. I thank you so much, Gurmeet, for joining me this Tuesday morning and for sharing your views. Wish you all the best for the trading session and for the week ahead. And to you, dear viewer, thank you so much for joining us this morning. I hope that this conversation helped you out. Do stay tuned. There's a lot more coming up in just a short while on BloombergQuint.